Today, we dive into the story of Melissa Kwan, and she shares her incredible insights as the co-founder of eWebinar, a SaaS solution to eliminate the repetitive task of running onboarding and sales webinars. She opens up about her personal journey of the stress of running her previous company that she led to an exit and sold. We discuss what bootstrapping actually means, and that actually raising a little bit of money is still a part of the bootstrapping. Melissa has some valuable insights that I'm excited to share with you. Let's go ahead and get started. Welcome back to the show. Today we have Melissa Kwan joining us. Thank you so much, Melissa, for being on the show.
Thanks so much for having me, Jason.
Well, you have a very interesting story, being co-founder of eWebinar and having a journey of pursuing venture capital, but having more of a mission now on only being bootstrapped and kind of promoting that as a message for other founders. I would think it'd be great for the audience to know a little bit about you, your background, and kind of what led you to that path.
Yeah, so I've been in startups for 13 years. So eWebinar is my third bootstrap startup. I guess I didn't choose to start this way 13 years ago. I just didn't really know there was another choice. And we're talking 13 years ago before Y Combinator, Techstars, all that stuff, right? Like I was living in Vancouver and there was just meetup.com, right? I don't know if you remember that. Like you would join groups and then you would go to a restaurant, talk about your startups. And then there were these things like co-working spaces and all that stuff. So I just wanted to start a business. I didn't even know that a technology startup was called a startup. I had quit SAP and I wanted to start a business on my own, and I had never really done it 100% of my time. So my first company, it was a product company turned agency. So, we needed the money, we were bootstrapped, and therefore we had to say yes to everything. So what started as, a real estate product, a real estate tech product, became a custom apps company for real estate developers. And that was actually my first foray into really getting into the startup community, traveling to New York, meeting other real estate tech founders. And then my first company, it wasn't an investable company, right? It became an agency. But that was where I learned about, that world, also going to New York. That company transitioned into my second company, which was my first SaaS product. It was an open house check-in app. So walking into an open house, instead of signing in on a piece of paper, we were the iPad check-in app for open houses. And we sold that to brokerages and franchises on the enterprise level. And, honestly, that company took probably 2.5 years before we earned the first $10. And how we started that company was I took all the revenue from my first company, took out a loan against that, and that's how we got the initial capital. We had burned through so much of that I was always in survival mode. And that was the reason why I moved to New York, to be closer to my potential customers, to be closer to real estate. And in New York was where I learned about venture capital, because everybody and their dog was raising venture capital. Every single event I went to, they were talking about different VCs and whether they could introduce me, because they knew I was in survival mode. And at that point, we were so poor that I was always trying to make ends meet by taking consulting projects, side projects, making a small website for people, trying to make payroll, we were just always trying to patch the next hole, and I was getting pretty exhausted. So the idea of building a company using someone else's money was actually pretty attractive. So, I met with VCs, tried to raise capital. Nobody would give me money. And then along the same time, we had started closing deals, found the product that people would pay for. And then within a year of, the first $10, we became profitable. Right. Also because our burden was so low, having the team in Canada. And I had at that point already learned to live with very little. And then I was also seeing that my venture-backed founder friends, while I was becoming more stress-free, they were becoming more stressful, because they were also always trying to raise the next round and, I guess, strategically creating a narrative around their company such that they can do that, right? And meanwhile, we were closing more deals, and I was starting to live better, travel more, calling my own shots. So in a big way, I guess I saw both sides of the coin, like trying so hard to raise venture capital, getting rejected so many times, and then earning my freedom eventually, but then also seeing venture-backed founders kind of going the opposite direction. And that was when I realized that bootstrapping and raising venture capital was really less of a financial decision and more of a lifestyle choice. And it was since then that I became, kind of a diehard bootstrapper and also an advocate for bootstrapping and hoping to, inspire other founders to know that success comes in many different forms and that they don't have to raise venture capital in order to have permission to succeed. And when I say permission to succeed, it's not like, a VC giving you permission to succeed, right? I think a lot of times it's like you want to seek validation from your peers. At least that was the position that I was in, because I never felt like I was doing the right thing. And I wanted someone else to give me money so that my community would see me as a success, because that's how I saw them. And none of that is real, because the only definition of success that matters is your own. And it was through that experience that I realized I didn't need someone else's money to be successful in my business. Right? The only thing that really matters to me, even right now, is to live the life that I want, where I can have fun in, where I could travel and spend time with friends and family and call all of my own shots. Right? And all my own shots to me just means like I don't set an alarm in the morning. I nomad 9 months of the year. I have a completely remote team. I work with a full team of contractors. I have made an active decision to not have any employees because I know I'm not great at managing people. And that's what I mean by calling all my own shots. It doesn't mean like I want to have a fancy car and have a yacht and fly private, right? So that's kind of my background on how I arrived at, wanting to always bootstrap my companies versus, raising venture capital.
Yeah, your story, I think, is going to resonate with a lot of founders, especially a lot of founders I've spoken to. And me personally, when I kind of made my first attempt to raise venture and failed, there was that seeking of validation of I want to do something bigger and kind of getting that approval. Albeit every founder has a choice to kind of find the right path for them. But I think it's important to kind of acknowledge that there's these other paths, like venture is not the only way. And sometimes venture is very misleading because you want money doesn't mean someone's going to be giving it to you for what you're building.
Yeah.
And it could lead you down a vicious trap that leads to burnout, closing up shop. And you took a huge risk. You took out loan against your other business, and like that put your other assets at risk, that, put your livelihood at risk and so on. So you put a lot on the line. And that's, some founders are not comfortable with that. I know I did that with my small businesses. I basically funded the startup that we ended up doing that ended up not going anywhere, because we spent all our productive time chasing money. And when we could have been serving our customers better, refining our business model to extract more profitability from the business to give us a longer runway and give us more flexibility in the choices that we made. So I think your story is not an uncommon one. And I think it's something that a lot of founders should realize, that they should consider their options. And that's why I wanted you to have on the podcast, because typically we talk about fundraising. We talk about how much did you raise, and we celebrate the raise and how'd you get there and what was the hassle. But I wanted to have a fresh perspective on the alternative, because there's a lot of societal pressure to kind of have this label of success. And there's ways to, and some of the most happiest and most successful founders running $10+ million year businesses or $1 million+ year businesses, but they have high profit margins, live the lifestyle they want, and they're comfortable. Whereas I know several founders that have raised tons of capital that only can pay themselves like $100K, $150K. They can't pay themselves the profits of the business. They aren't profitable. So there's, you can't really just give yourself higher salaries for the sake of giving yourself higher salaries. So from a lifestyle perspective, until there's like a real exit point, there's not a lot of financial freedom. And so, appreciate you sharing your perspective. You kind of talked about the real estate solutions that you had built out from agency to the SaaS, but you're also in a new company now called eWebinar. Can you tell us a little bit about that?
Yeah, so eWebinar automates webinars, right? So we turn any video into an interactive webinar that you can set on a recurring schedule. So you can run hundreds of webinars every single month without actually being in front of a camera to do it live. So think about all the things you're doing repetitively or want to. So it could be like demos, training, onboardings, especially if you're, selling SaaS or any service. Activation and churn is probably one of your, biggest revenue drivers. So we help companies scale really themselves so that they can do more, with their time. And it's actually a product that I wish existed when I was running my previous company because I was so bootstrapped. So I was the person after closing a deal doing all of the demos, onboarding, and trainings for people that don't show up. But, you have to do those because if, your customers, team or agents don't adopt your product, it's your fault, not their fault. So sometimes I found myself doing like 8 of these back to back and they were all exactly the same, just for different companies. So I'd always dreamt of this product that could, do my job and that, could clone me so I could go and just live my life. So after, 2 months after I sold my previous business in 2019, I started this business. And it's been, 4 years now since we incorporated, 3 years since the product has been live, and we just crossed $1 million ARR.
Congratulations. That's awesome. And can you tell us, it's your last business. So you're telling us about the SaaS. Was this the SaaS business for real estate open check-in that you sold? Yeah. It was called Spaceo. Can you tell us a little bit about what that experience was like selling the company?
Yeah. It was so easy for me, right? Because I didn't shop it. I didn't want to. I was in a point in my life where I spent 10 years in real estate tech, over 2 businesses. And frankly, I was just tired of where I was, right? There were a lot of cool things happening in the world that I wasn't a part of. I found that I was waking up every day just hating what I was doing. I really didn't love the product. I wasn't in love with the industry. I didn't love my customers. And I was always frustrated in a way that I just couldn't feel the successes that we were having. I just didn't want to be there. And I couldn't tell my co-founder because, this is someone that I had convinced to join my mission and my journey. I couldn't show that to my team. So it felt very lonely. And at that point, I was just kind of complaining to one of my, industry friends and mentors, Aaron, who ended up buying my company. So he was like, I just said to him one day, I wonder if my co-founder would let me sell my share so I could move on to something else. I just wanted to be a part of something else after 10 years of being in the same place. And he was like, hey, if you're serious about that, we're looking to make our first acquisition, but you're going to have to stay. So we started having that conversation October of 2018, and we closed that deal 2 months later in January of 2019. I didn't shop the company because I knew Aaron. I knew that the offer he was going to make me was going to be the best one. There were so few people in the industry that I would work for. And I had spent so many years until that point earning my freedom, because I was also nomading at that point, calling all of my own shots, that I didn't want to work for someone who would disrupt my lifestyle. It was most important for me that, it was a CEO that I respected, that it was someone that would take care of my team, and that it was someone who wouldn't change my life. So I didn't want to jeopardize what I had at the time. And also, because he was my friend, I didn't have to put on a dog and pony show to sell the company. He knew where I was. He knew that my heart wasn't there, but that I would show up for him. And that was most important. So I think a lot of people think when you sell a business, you have to get the highest price, but it's not that's one element, right? I think as long as the price is kind of in the range, there's so many other things to consider when you sell your business, because it's not like you can sell this business and move on, right? You're with them for let's say 1 to 3 years. So I was lucky enough that I just came across someone who took care of me and took care of the team.
And the fact that you kind of mentioned price and the acquisition, it's wasn't the sole decision-making factor. That's often very common I see in the negotiations for fundraising as well. Everyone gets so hung up on, I must get the highest price. I want to have the least dilution. I want to make the most money, whatever. But there's so many other terms that matter in both an acquisition or fundraise that could have a much longer impact on the future of the business, as well as, the mental health of the founder. And it sounds like you were very conscious of that decision. And, your friend probably knew your deepest, darkest secrets. He probably knew the skeletons in the closet of the business and was probably comfortable with them and knew, maybe there's some additional upside. What was the lockup for? Like, did you have to stay for a certain amount of time? Like, at what point were you kind of allowed to exit the business after the acquisition? And did he only buy your shares or did he buy the whole company?
Yeah, so they bought the whole company. We were actually part of their plan to exit themselves. So they wanted to buy our revenue so that they could piece together a story to have a much larger exit themselves. So that was also part of the attractive thing is like, it's so rare that you sell a business and like the person gives you all cash or the company gives you all cash, right? It was like cash, stock, and earnout. So the earnout was 2 years. I managed to negotiate like a 6 months early out just because they didn't fully find a place for me. And I think that's a pretty familiar story. Like one company can only have one CEO. So it's very, very difficult that, a CEO buys another CEO and then, you also get to call the shots. And when I joined that bigger company, like there were multiple people already doing my entire job. So there wasn't really a place for me outside of making sure that our customers felt comfortable because I was the business, right? Because we were a small business. So I was all of our relationships. So it was more important to that business that our customers stayed, and all of them did. So I was there for that transition, but it just got to a point where I wasn't there for a good reason. Like I was just there. So I think it worked out for everybody, but also because I started eWebinar 2 months after that business was acquired. So a year and a half later, eWebinar was about to go to market. So I basically just told them like, I'm not really here for any reason. I'd like to launch this new business. So we kind of negotiated a 6 months out that was beneficial for both sides. But I also want to bring up that the only reason I was able to sell that business is because we were bootstrapped. There is no way that a VC would let us sell that business at the price that we did, because they would want me to go for a much larger exit. They want a certain return. Either, I would have to keep going or they would have to hire a new CEO. So that exit was not retirement level, but it was certainly life-changing. And I can't imagine not being able to sell my business at the time that we did because a third party who didn't spend 5 years building that business told me I couldn't, right? That would have been also life-changing, but in a bad way, right? Like I would have had to quit and then give up everything and then maybe have to start a new thing without the capital and the confidence that I did get from that exit.
Yeah, it's a good point of contrast, and going back to kind of the bootstrap versus, capital raise path, and that kind of expectation that if someone gives you money for your business, they're they're saying goodbye to that money for years with the expectation that you're going to at least 10x, 100x, whatever that projections are meant to be. And life happens. People have life-changing events. Maybe people have kids. Things happen at home, personal reasons, whatever it may be. Just disinterest in the work that you're doing may happen. And, if an opportunity to sell comes up, are you in full control of that? And that's another negotiation tip when raising capital is who has veto authority in any potential liquidation event or the sell of shares. That can be a more important negotiation chip than a couple $1 million on the valuation of a deal, or whatever it might be. So it's interesting for you to kind of share that personal perspective of you would have had to stay. Even if you raised a nominal amount of money, there would still probably been some pressure and expectation that probably wouldn't have allowed you to even think that you could sell it anywhere at around that price.
Yeah, I mean, there's no free money, is there? Like, even though it feels free in the beginning, it's not free when you need to get signatures.
Ooh, another valuable point is, when things aren't going well and you need to go to your board, go to your investors and have them sign something that could maybe put you in a healthy position, but puts them in a negative position. That's a very tough call. And I've been there. I've had to deal with a down round after an acquisition fell through the day before, and crawling back to our investors to get the capital we needed to stay alive, we got hosed. And when we actually ended up selling the company, we got substantially less than we could have because of those negotiations that happened. Still life-changing, but still punched in the gut, because the investors held the chips at that point.
I think if we're on the topic of like raising capital, right? I think one of the biggest misconceptions about bootstrappers is we don't have any capital. Like we don't have any external capital, which is untrue, right? Because between zero and VC, there are different types of investors, and family and friends being, a big source of initial funding, especially when you don't have anything revenue generating yet. So like, I don't think people think enough about how it doesn't matter how small the shareholder is, that's still a shareholder. And when you want to sell the company, every shareholder needs to sign. And I've been in a position in the past where, a family and friends investor, and while it's an investor, I think we traded equity for work at that time. And a lot of people do that, but they never think about, oh, it's just, 0.2 or 1 or whatever it is. That 0.2% that you gave away will come and bite you if that person doesn't want to sign the document. And that happened to us in the previous company where we traded work for equity. It was a friend at the time, but it was no longer a friend years later. This person held the equity under his company, which he then sold to a public company without telling us. So that percentage mattered so little to him. They didn't even think about it. Didn't even offer it back to us or offer to sell it back to us, and just did it. Didn't think about it. Didn't talk to him for years. When it came to signing those documents, for the life of us, we could not get that public company to respond. And I thought that because we had a drag-along clause, that the deal could just happen without a signature. So 2 days before the deal was supposed to close, my lawyer was like, well, we're missing the signature. And I'm like, well, I can't get a hold of this person. So can you just do execute the drag-along clause? He's like, what do you mean? The deal's not going to close because even though you have a drag-along clause, you need to take that person or that company to court and have a judge say that everyone's getting the same deal before we can actually drag this person along. Having a drag-along clause, at least in Canada, doesn't mean you could just drag everybody along because there are natural laws in place to protect every shareholder. So at that point, I'm sweating bullets because I didn't know this. So I had to go through like every channel to somehow find the mobile phone number of the CFO of that publicly traded company and text him this sob story so that he would then go and sign those papers. So it doesn't matter who the investor is, even if it's a family and friends, small investor, a shareholder is still a shareholder. And that's something to think about when you're joining an accelerator, when you're trading equity for work, right? When you're taking a tiny check because you just need the money, think about whether this is someone that's going to be on your side when you're going to sell that company, because it will matter.
Ooh, that's a tough drag along. That might be a Canadian thing only, because I know when we had drag along we had drag along risks in our previous companies, and we had the ability to kind of just ignore the fact that they didn't sign. They tried to push, but it basically didn't come into play. And there was also just so many small checks we take. But I guess maybe that's unique to Canada, or maybe our terms are a little bit different. But that's tough, and that's a very true, whether it's drag along or not, a reality to take into consideration. I'm glad you shared that with kind of raising capital. So you kind of mentioned earlier about taking capital and like getting smaller checks or work for equity, type deals. How did you price them? How did you negotiate it, and kind of what was your mindset around accepting those terms or drafting those terms?
Yeah, so I mean, I'm always erring on the side of everything should be as vanilla as possible, right? Because even though we're not raising venture capital today, I can't say there's a zero chance that we're ever going to go that route, right? Maybe one day we'll decide, okay, well, this is the path we want to go. And I don't want anything to be complicated and out of the norm if we ever go that route. So we've always drafted everything properly as if we were a company that is raising venture capital. We used safes, convertible notes, everything is documented as if we're raising from institutional investors. I think that's the way to go, right? Like we have, founders have vesting schedules, shareholders agreements. But the way that I've done it with eWebinar is a little bit different than I've done it in the past. We do have family and friends investors. David, who's my CTO co-founder and my life partner, we wrote the first checks. Everybody has to have the exact same terms. And that's also because, we're raising from family and friends. It has to be like, we don't want anyone to feel like they're being cheated or they're getting a lesser deal, right? So everything's transparent. Everyone's on the same terms. If you can't agree to those terms, then you just don't come into the round. The very different thing that I did with eWebinar is we have, number one, we have a minimum. So we have a $50K minimum because I don't want a big cap table, right? For the reason that I just explained. And I don't want, I want as little people as possible on my cap table. I only want people who are on my side. I only want people who are our best friends, we vacation with, right? Because I envision a world where we can share our successes with friends and we can have investor retreats and all our friends are going to be there. And it's going to be, one big party. And the major difference is the terms are structured such that this is a profit-generating company, which means dividends are paid out according to your percentage of investment and not percentage of equity holding. So you can have 1%, but have 10% dividends entitlement. Because the idea that you have to wait until an exit to get your money back never really made sense to me. And because we want to be profit generating, because I'm not building this company to sell, and because I don't intend to raise venture capital, I want to make sure that people can get their money back long before we actually sell the company. And if we do sell the company, then it would be kind of a cherry on top. And these are all people that, we don't have a lot of people on our cap table, but these are all people that are successful, but not entrepreneurs. They're not going to go and start something else. And these are people that are maybe in the later stages in their lives, in their 40s and 50s, and they're looking for passive income. And I've sold this as a passive income company for them because this is going to be a passive income company for me. So I want to give everybody involved the life that I envision for myself. And hopefully we'll get there sooner than later.
That's not something I hear often. And it's a refreshing perspective to hear in terms of, dividend payouts. Because, I've talked to founders that wholly own their businesses, but when they raise a little bit of outside capital and treating it more as a passive income opportunity, which, if you listen to TikTok and personal finance on YouTube, it's, all the rage trying to get passive income, and, you're selling what people are buying. I guess, what are some of the mistakes that you see other founders make when trying to maybe raise friends and family rounds and trying to bring in, either maybe some advisors or some people that can add value, but in particular, just that small round with the expectation that maybe they don't go out and raise a big round down the road?
I mean, I think the number one mistake I see people make is having too many friends and family investors to start with. I don't know how much a $5,000 check can have on your business, but I do know that means a lot of signatures, right? That's the one thing I think about, because I feel like I have a bit of PTSD from selling my previous company and not being able to get signatures. But, when things are good and, you're selling a dream and everyone's happy, everyone that knows you wants to contribute a little bit, right? And of course you want that support and you don't want to turn them down and insult them in any way. But what you really want as a business owner is capital that makes a meaningful impact in your business, right? And so I think if you start the company by having a really big and confusing cap table, if you ever want to raise, institutional investors in the future, it's a bit of a red flag, right? So I think you want to keep things as clean as possible. And also, I think it sets a bad precedence for people coming in, because like one of the reasons why we had a minimum is because I don't want someone coming in and say, well, I want to put in 10,000 because this other person put in 10,000. Why aren't you taking a small check from me, right? So I want to set a precedence that like, this is not one of those companies where we'll take a check from anybody. But also, it's almost like self-selection, right? I only want people who can afford it, because the number 2 mistake I see people make is they take money from people who can't afford it. And they're almost pitching their company to friends and families as if they're pitching to an institutional investor, which is not the same. The first thing I tell my friends and family is, you could lose this. I could lose this. So don't write me this check if you can't afford to lose it. Like, assume you're not going to see this money for the next 10 years. What would you do? Or assume you're going to lose it. What would you do? Right? So, and in the past, I've had people who wanted to invest in our company, but I knew they worked really hard for their money. And I knew even if they told me, yeah, I don't mind losing this, that it would make a big impact for their life if they did. Or taking that chunk of money away from them right now would make a big impact on their life. So I've actually in the past turned down checks until we got to a later stage where I was comfortable taking that money from a friend, right? So I think that's the second mistake, is like, you're taking money from people who can't afford it. And investors and institutions, like, maybe it's okay to do that, but if it's your friends and family, you should not put them in that position. And I think a lot of people, like, when they need the cash, like, don't think about the impact that they could have on someone else that is just not as well off as a company.
And not only is that out of respect to your friends or the other person that might be interested in writing that small check, it again saves you the burden of responsibility down the road, because things don't always work. Most things fail. And when that fails, that could kill the relationship, and like, hey, I gave you that money and you lost it. Like, it can turn things pretty negative pretty quickly. And I think it's smart to have that level of foresight and respect for, other people's money when, not just taking anything and everything you can. And, one thing I wanted just to add as some input for our listeners is an alternative to kind of prevent the signature problem and the too small a check problem, assuming the affordability is not an issue. Something like founder-led SPVs, where founders can basically aggregate a bunch of small checks as one line item in the cap table, kind of solving the too many people in one they're on the cap table. And then so it's one signature and it's led by the founder, and the founder signs it off. So basically the investors have to agree to that. They basically get no representation, but they get a piece of the, whether it's a dividend structure or payout or anything like that. It goes through the SPV and gets distributed from that, as opposed to having to be all individual line items attributed back to the company. So just food for thought for those listening.
The other thing that, when to take note of when you're raising money from family and friends, and maybe even new funds, right, that are not used to investing in this type of asset, you have to know that if they need that money and they've given it to you, they are going to call you all the time to ask you when they're getting it back. And that's happened to me before, where, it's a person that, wrote us a $100,000 check. He's never invested in this thing before. And then he just called me like every 2 months, like asking me when I was gonna, when I expected to sell the company. And then I felt really bad. Right. And I, it just wasn't a great position to be in. So something to think about when you're raising from non-experienced investors is like, that is a potential, that's a potential scenario that could happen, because they're thinking about, like, they're not really thinking about it as an investment, but thinking about like almost losing it, because, in their bank, if they put this in like a GIC, they could cash it out. But now they've written a check to you, like, they maybe mildly regret it, like a low-grade regret, and they just want it back. So another reason why you'd want to like raise money from people who are either well off or like experienced.
Yeah, no, focusing on accredited investors that have exposure to private markets and understand that this money's gone for the foreseeable future, especially in private companies, 5, 10 plus years is kind of the baseline to expect. And so sounds unfortunate. You kind of had the dealings of all the kind of negative experiences. So I'm glad you're sharing, so that hopefully people will take a lesson from your book and navigate those checks a little bit more strategically and think about the long-term ramifications and the qualifications of what comes with that check.
Well, the reason why I had such interesting experiences, I would say, is because I was so desperate in my previous company, right? I just needed to make payroll. And unfortunately, that's what happens when you don't have choices, right? Like, I didn't feel like I could say no after being in survival mode for so long. And finally, this private investor agrees to write me a $100,000 check. And it just didn't matter at that time who they were. It mattered that I made payroll and that I could breathe a little bit. Because not only could I miss out on payroll, I was also not paying my own vendors. So, so I had not just my own debt, but I hadn't paid my lawyer for 2 years. I hadn't paid my accountant for 2 years. These are people that keep my company running. So unfortunately, in those positions, you make quick decisions that may not be the best, right, for your company in the long term. And even thinking back now, I'm not sure, knowing what I know today, if I could have made different choices because of where I was. But hopefully having this conversation and maybe someone listening, hopefully this conversation can help them think, deeper into, who they let into their company.
Wow. I really appreciate the level of transparency and candor in terms of expressing that, because that's a very valid point here. It's one thing for us to kind of say, oh, don't do this, but then when you're kind of in the trenches and you don't have a lot of choices and someone's kind of giving you a lifeline, there were certain strings attached. Either you can not take that offer and die, or you take that offer and deal with you live another day to suffer consequences down the road.
Yeah.
That's some valid input. Well, Melissa, I'm curious for founders to know kind of where can they learn more about you, what you're doing. You have a podcast yourself. Do you want to kind of talk about that a little bit?
Yeah. So where you can learn more about me, just connect with me through LinkedIn. My last name is spelled Kwan, Kwan. So that's Melissa Kwan. I actually post daily about my experiences bootstrapping 3 companies. So if you ever want to learn about my war stories or whatnot, that's the best way to connect. And of course, eWebinar.com if you're wondering how eWebinar can help you in your business. But my podcast, Profitled, I started it really to talk about other success stories from bootstrappers and invite other people to share how they were able to grow their business without venture funding, and hopefully to inspire more founders to know that there are different faces of success and that the only definition of success that matters is your own and not appearing on, the cover of TechCrunch. Actually, we're launching our season 2, which is going to be focused on our own journey to $1 million. So instead of inviting other founders to talk about, their bootstrap war stories, we're actually going to spend one episode, one topic per episode talking about, our trials and tribulations growing to $1 million, around things like how to recruit on having no resources, mistakes we've made, misconceptions about bootstrapping, customer horror stories, things like that.
The de facto Bible of bootstrapping, it sounds like, of, what to do and not to do, and, lessons learned from people that have already kind of been in the trenches. To, again, part of the reason why I have my podcast is to help founders know what's ahead so that they can start thinking about it, because other people have already been through this. There's very few stories that are completely original and unique. Everyone's kind of had their, similar exposure, similar experience, and, it's grateful that you and your podcast are out there for founders to know in terms of navigating the bootstrapping world, and also just to take it as a genuine consideration. I think every founder that wants to be VC backed should just take a step back for at least a minute and acknowledge that there is an alternative and what that might look like if they chose that path. And I think it's a challenge we're taking, into which I think a lot of companies did that kind of in the pandemic and post-pandemic when the capital dried up. Is how do they get to profitability? It's kind of been the big ask for a lot of VCs, where it wasn't the case before. It's grow at all costs. Now it's like get to break even, get to profitability.
Yeah, profit's cool again.
Yeah, it's cool again, and it's good. You want profit. Profit enables opportunities. But Melissa, I really appreciate you being on the show, sharing your journey, and sharing your advice with the founders that are listening to Fundraising Demystified. And it was nice to have a change in our typical programming and kind of hear your story today.
Well, thanks so much for having me again.
Awesome, appreciate it.